this teaching on the second X, and we're excited. We've covered, if you've come this far, we've covered the first X teaching on what we call the triple X factor. This is a picture, in case this is the first time some of you may be seeing that, of what we call the third X, and so, or the triple X factor. And so we've covered the first X, and now we're going to start talking in this video about the second X and what the second X is, and the laws that you use to help you develop and grow into the second X. So one of the things I want to do, though, to get us back into the video is I want to review a little bit. First of all, we've talked about this in the previous videos, what we call the first X, and just as a quick reminder, right? So the left side, 0 up here to the top, represents our monthly income and monthly expenses. And then we have the black dots actually represent the monthly income, and the pink dots here actually represent your monthly expenses. Down here on the bottom, these are actually months. So like, for example, if you were going to start at the first of any given calendar year, this would be January, February, March. And so you just simply put a dot with what your household income is for the month, for example, if this is January, and then you put what your household expenses are. Remember, we said in most Western nations, you can obviously spend more than you make because you can put it on credit cards or in consumer credit. And so we've shown you how to reduce that, how to increase your income. And of course, when your expenses get below what your monthly income is, then the first X is formed. But the real question then is, what do we do now that we have excess capital here? We actually have more money coming in than we do money going out. So now that we have more money coming in, we're going to take that money, begin to set it aside, and invest it in assets that we're going to talk about that increase in value over time. And then as that line begins to grow and crosses here, your expense line, it's at that point you hit financial independence. If you want to, you can quit your job because you have what we call second X income or passive income that's coming to you from your assets that are paying you. We're going to really explain this in these next several videos to you. So let's look here at another chart that'll help us. I'm just reminding you here of the triple X factor, and then this is the third X here at the top, making a difference. And the third X is where now we actually have enough money we have coming in that we're financially independent. As I stated, we can quit our job if you want to. And it's at this level you now have enough money you can live. And one of the things that's real powerful, we'll come back to this, but then if you get to what I call your target living allowance, then what you can do is start actually giving away 100% of your income above your target living allowance. Here, you're bringing your tithes and your offerings at the first X. You're bringing your tithes and offerings at the second X. But as you get up here to this level, which we'll explain to you when we teach on the third X, you actually are able to give away 100% of everything that's above your monthly budget or above your target living allowance. And so now let's look, for example, let's go back and remind ourselves of the different kinds of income or money that is at each one of these X's. We're just going to cover, this is a chart. We talk about the first X again. Remember, we've taught on that. That's money that you work for. It's primarily what we call job income. The kind of income it's at a job level, and usually you're an employee or you're self-employed. We call that non-leveraged income. Then at the second X, which we're going to talk about in this particular video and several others that are to come, really, at this level, it's no longer money that you work for, but now it's money that works for you. It means that you've taken your money, you've invested it, and that the earnings from that investment are now paying you. And so, again, the purpose is very similar, and what you're doing is asset building, but the type of income now is assets. It's not that your job is paying you, it's that your assets are paying you. When I really began to get a clear understanding of this and began to realize that I need to focus on assets that pay me, which, by the way, in this video and the next several videos, we're going to go into a lot of detail on what those specific assets are. It will help you understand it. So just stay with us as we go through this, because we'll help you process and understand what kind of assets you want to have in order to be paid at the second X level. And then the category we call that is you're a business owner or you're an investor, and it's really, in this case, this is income that you manage, or really you're managing the assets that's paying you. So remember, you're moving from money that you work for to money that works for you. And we'll come back a little later as well when we get to the triple X and show you what the third X is. But let's continue on today actually with what we call the triple X factor. And we're going to kind of show you this in some of the laws that we're going to cover in the next several videos. So here, since we've already taught on the first X, you see that here. And now we're taking this excess capital I just referred to, and we're beginning to put it into assets that are paying us. Now, let me give you an illustration of what I mean specifically about the green dots. So as you start seeing this, as you start taking excess capital and investing it, then you can start building the green dots in your life. And what a green dot, the best way to understand a green dot is a green dot would represent, for example, one single family house that's paying you rent, and that rent has positive cash flow. That means after you pay your expenses, like your principal and interest on your mortgage, your taxes and your insurance, after you do that, and let's say you have a $300 positive cash flow over and above your expenses, then the green dots will represent that. Now, in a few minutes, as we begin to do this, I'm going to go into more detail of specifically about what kind of income those green dots would represent, but that just gives you an example. And so as you start taking and putting money aside, then you're able to do that. Now, I just want to make one note and one exception here. Some of you, in fact, let me just say probably by far the majority of you that are actually watching these videos, you would be able to still have not reached the second X, or excuse me, I'm sorry, the first X. You might even be on the left side of the first X, and you probably could go ahead and start building some green dots before you're completely out of debt. Most people don't know this because I teach you in the first X how to get out of debt. Well, we give you the 9 steps to getting out of debt, including your mortgage. But I have many people who have actually started building the green dots. Now, later they, of course, got completely out of consumer debt, and their income, even at their job level, was more than they were spending. But what they did was, some of them, they would get like a second mortgage on their primary home, or they would get what we call a home equity line of credit. This is only one example that I'm using, only one example, but they would actually say borrow, that have enough equity in their home that they would borrow against that equity, and then they would start buying single family homes, for example. Now, I want to be clear. I'm not just teaching on real estate or single family homes. I'm only using that as an illustration, that's one of the easiest illustrations for people to actually understand. Some people may say, well, I don't want to get into real estate. Well, you stay with me. I'm going to give you quite a few choices here on these green dots here in just a minute. But there are some things that the green dots are not. And I'm going to talk about some of the things that the green dots are not. But what they are, as an example, is this so you could take $100,000, for example, if you had it in equity, or 50 or 25, whatever, and you could start then using some of that money as a down payment. So let's just say if you're able to take $100,000 as a equity in your home, which I know for many of you sounds like too much and a lot of money, you're just not maybe there yet. But there may be some watching who say, yeah, I have $100,000 in equity, and they can withdraw that $100,000, and then they can use $10,000 at a time to put it on as a down payment, say, for example, on a $100,000 house. I want you to know that I know many of you are watching from all over the world, and many of you are watching in different parts, for example, of the United States. And in some parts of the United States, there's no such thing as a $100,000 house. It's either a $300,000 or $400,000 or $500,000 house. But in many places, there are many $100,000 houses. So I'm only using these as illustrations. You'll have to do your own math. But what would happen is that each one of these dots would then represent income. So you see, I'm right down here on the very bottom. So this is right out about, this first dot's right out about 300 a month. And so as you start coming up to the 1,000 mark, now you're coming up to the 2,000 mark. So this would represent 1, 2, 3, 4, 5, 6. We have one missing here, 7, 8, for example. You'd be right up in here. 8 properties would put you at about that number if you had positive cash flow of 300 a month. So that lets you understand. Again, I'm only using real estate as an example. So the idea would be that now you have enough of this positive income coming in, it actually passes these expenses that you have in your life. And if you noticed, even your expense line here is actually coming down, because what happens as you begin to build assets and build wealth, you are able to begin to pay some of your personal debt, consumer debt off if you haven't already done it here. But the beauty of what Becky and I learned, my wife Becky and I learned, was as we began to build wealth, we were able to pay off our personal mortgages, and we got completely debt free with those. We also were able to pay cash for our automobiles. And so what happens is when you have the largest things in your life that you're using and you're not paying any debt on them, you do have monthly expenses like utilities and groceries and things like that, taxes, you have things like that you have to pay. But the bigger expenses that normally eat someone's budget up, when you really get to this level, it's true that these pink dots can actually start coming down. Now, in the first X, we actually talked about these laws over here: law of wisdom, law of change, law of stewardship, and law of lift. And as we start talking about the second X, we're going to actually begin to talk about some of these laws: the law of leverage, the law of acceleration, the law of income, the law of compounding, the law of conversion, and the law of risk. And so as we get into teaching this, I want you to see that there are some laws that you can begin to apply that'll really position you to begin to build the second X in your life. Now, one of the things that I want to do here is I want to start, first of all, with the law of income, so that there's an understanding of what we mean when we're teaching on the second X, when I talk about these green dots. And so I have a definition, and it says, what is second X income? And so I'm going to give it to you here. Second X income is receiving positive cash flow. So you're receiving positive cash flow from marketable assets, meaning assets that can be sold. That's what the term of marketable means. Now, we're not selling them. We're not selling them. We're saying they can be sold. In other words, somebody else would like to buy what we're talking about in most instances. And then that increase in value over time. And I'll talk a little bit about that here in a minute when I give you kind of a better definition of value. So second X income is receiving positive cash flow from marketable assets, right? So a piece of real estate, a single family piece of real estate, is a marketable asset. And it's paying you a positive cash flow if you have, for example, as an example, I was saying, you have, say, at least $300 a month that you have over and above your expenses on that property on a monthly basis, then it's actually paying you, plus the property itself in most environments is going up in value, so it's increasing in value over time. And so there are other assets we're going to show you besides real estate, and we're going to give you a whole list here of things that you can do, and they all fall within this second X income definition. And so let's talk a little bit about some of the things that we're not talking about and some of the things that we are talking about. So the first thing that I want to say here is what we're really talking about is income. And that's why I call this the law of income. That for the second X to really mean something, what we're really talking about here is we're really talking about replacing your employment income. So if you are able to replace your employment income, that's really one of the first goals you want to make. And I in my story of what I was able to do, I had a reasonably good first X income. I had a reasonably strong, what I call job income that I was making in my life at the time I set out on this particular journey of reaching the second X in my life. And so my goal was to replace my employment income. That was my total goal. And I was able to reach that in a reasonable, very short, not just a reasonable, very short period of time. I was able to do that in 30 months, 2.5 years. I was able to accomplish that. One of the reasons is I had the income to invest. But I also I caught the market correct, and rental markets were going up very strongly while real estate was still going up in value. But it was the rental market, the strong rental market, that allowed me to be able to buy a little bit lower on the real estate itself, but charge a good rent, a strong rent. And I was able to do that in 30 months' time. For many of you watching, that may take you as long as 5 years, and for some, 7, 8, 9, or maybe even 10 years. But you can get there if you'll be patient. Now, if you want to get there in a hurry, it's still possible to do it in a short period of time. You'll just have to increase in the law of wisdom that we've already taught on in order for you to do that. And then as you do that, I believe God's favor will be on your life, and you'll be able to accomplish what your goals are. Now, let's go back to the income for a minute. Let's talk about second X income. So first of all, we're talking about income that comes from assets without selling the asset. And so one of the things that we showed you a little bit, we referenced, is that what we're really looking to do is to build an apple tree, right? We're not looking to grow broccoli, because broccoli has to be harvested every year. You have to cut it off at the stalk, and you bring it over to your pot, you boil it. But then if you're going to have broccoli next year, you got to go back and plant the broccoli again. Whereas what we're really talking about doing is income from assets. So an apple tree is an example. When an apple tree grows and begins to produce apples, I can go pick the apples, but it doesn't kill the tree. The tree, as long as I manage the tree, I protect it, right? I water it, and I protect it from the bugs and the heat or the cold. As long as I protect it, I manage the asset, then every year that apple tree is going to give me apples. And really, my goal, right, is to get several apple trees when we talk about this law of income. And if you really want to build wealth, then what you're really talking about is getting an orchard, right? And so what we're talking about here, income that actually comes from assets. And it comes from assets without selling the asset, without killing the apple tree. It's really important. And then the second thing is that, and this is really important, is we're not talking about waiting 35 years or 40 years as the financial industry in Western nations teaching you, saving your money for 35 or 40 years, even though that's not a bad plan. I'm not saying that plan in and of itself is a bad plan. What I'm saying is it's not a complete plan. The complete plan is that you begin to invest now, today, in assets that pay you now. And I didn't say you were going to take the money. Okay, but I'm not talking about assets paying you because they increase in value. That's a good thing, and we'll get to that later in the third X. But right now, what we're talking about is assets that pay you either monthly, quarterly, or yearly. Now, I'm not saying you have to spend the money that you get paid, but if our goal is to replace our employment income, if that's our goal, then we want those assets paying us income monthly, quarterly, or yearly, or annually is what we're looking for. And then the third thing we're looking for is income that is taxed lower, right? It's called, in most Western nations and in many developing nations, it's called passive income. So earned income, in case you don't know it, is the highest taxed income there is. You go work, you get a job, you get paid, and they give you here in the United States what's called a W-2, that's earned income. It's the highest taxed income there is. Passive income, for example, as we're talking today, is in most places here is taxed between 15 and 20%, depending on whether you have a state tax, not a state, but a state tax. Somewhere you live in a different state where you have to pay income tax. And so, but normally passive income is at much lower rates than what we call earned income, and that's in most nations around the world. And then we're talking about income from assets that increase in value as the income increases or it goes up. I call those kind of assets, I call those assets that have intrinsic value. A single family piece of property has that example, and a commercial piece of property really has it. because you value it based on what is called the income approach. And so it can go up or down based on the income. And then we're also talking about income that is residual. In other words, the apple tree is going to continue to produce apples year after year. Now, let me tell you what I'm not talking about before I tell you what I am talking about. I am not talking about here, when I talk about a definition of these assets that actually produce income without you selling them, I am not talking about gold and silver. Now, as you're watching this video right now, I can tell you that the stock market has gone down here in the last couple of days, the last half week or so, including today, and it's trying to go up. But the point is this: is that there are safe haven assets when there are uncertain times, and one of those, for example, is gold and silver. But when I'm talking about assets that produce income, I am not talking about gold and silver, even though I own a lot of gold and silver. I am not talking about that. I'm not talking about crypto. I want to be clear here, because crypto goes up and down, but it doesn't pay you a dividend. Now, there's some crypto, some currencies, some digital currencies that are coming out now that actually will pay you a dividend, but there's all kinds of potential problems with that, and so we'll talk about that in some of our other programs when we're teaching on crypto. But what I am talking about is assets that actually are paying you without you selling them. And here's some examples of what I call examples of the green dots that you saw on the second X. And one of those is rent from real estate, which I've already told you about. And then another one is distributions from a business. And I really mean by this capital distributions. Now, it's hard to get distribution from a business if you don't actually have profits. So your business has to be profitable in order to receive a distribution. But rent from real estate and distributions from a business are all taxed at the passive income level. So I notice I did not say salary from a business. Now, you can pay yourself a salary, but you're going to be taxed at earned income rates. However, distributions from a business, you're not taxed at the higher rate. You're taxed at the lower passive income rate. Another is dividends from stock. Now, again, I am not talking about here buying and selling stock in 12 months or less, where it goes up and you sell it. Now, if you hold stock for more than 12 months and you want to sell it, for example, but then you're having to kill the apple tree to be able to reap the profit. What I'm talking about is there are things called dividend-paying stocks, and many years ago, going back in the 1950s to the 1950s and early 60s, most people never even purchased a stock or anything in the stock market unless it was paying them a dividend. That was just the normal process of business. In this day and age, right, with all the new artificial intelligence we have and computer trading programs that we have, people are buying and selling stocks all the time. But the minute you sell, you kill your apple tree potentially. What you're looking for is stocks that are paying you dividends that you don't have to sell in order to be paid. And then we're talking about interest from bonds and CDs. And actually, we've just come out of zero interest rate level environment. And today, as I'm recording this, just what we would call our Fed funds rate is at about 4.5% to 5%, and I believe it's moving up from there. And so right now, interest from bonds and CDs is actually becoming much more of interest to people. And then we're talking about royalties from songs and books, and this is really an intellectual property. This is some of my personal favorite. What I'm recording today with you is intellectual property that we own, okay? And then the last one that I'll emphasize here is royalties from oil, gas, or minerals. And so that means that you get paid, for example, you receive a royalty off of your ownership in oil, gas, or minerals. And so, for example, you could receive royalties for something where a gold, if you owned the ground and you were being paid out of it, you could receive royalties from gold if it was being mined. I'm talking about when you buy gold and hold gold, that's what we call actually harvesting broccoli. But if you owned the land where it was being brought up, then royalties from that gold would be of course considered here. And so this is 6 examples. I think it's 6. Yep, I got 6 examples. I have a couple others, but these are the primary. Now, here's what I want to say to you as I close this video. I want you to understand I'm not talking about 17,000 different things or ways for you to focus on building wealth. What I'm really talking about here right now is only 6. Right here, on here, only 6. And it's important that you learn at least something about 2 of them so that as you begin to put that together in your life, what happens is you are building this second X income, this residual income that continues to come from the assets that you own. And so as you begin to do that monthly, quarterly, or yearly income that's taxed at a lower rate, and it's coming from assets, right, that I just listed, right? We've got real estate here. We've got businesses that you would own here. We also have stocks, as long as it's dividends that are being paid. We have bonds and CDs. We have royalties from intellectual property, and we have royalties from oil, gas, or minerals. So those are the areas that you need to learn something about, and that's the reason that most people will gravitate, generally speaking, many times to the first one, which is real estate, but you need a second one. And the second one that a lot of people do is they build businesses and take the income from the business and then invest in real estate. Those aren't the only ways, but these other 4 ways are things you can do as well. And so here's what we're going to do. I'm going to pick up with you in the next video, and I'm going to start showing you the laws of wealth that you need to begin to operate by in your mindset and your thinking in order to be able to build this second X. So I'll see you right back here on the next video.